In today's episode, we are going to discuss how are traders taxed. But before we do that, don't forget to subscribe, like, and share this video. Hello everyone, I'm Abby, the relationship accountant. I help retail traders maximize their tax savings, and I teach traders how to trade under a business instead of their social security number. So who are you and how IRS sees you is two different things. IRS states that if the nature of your trading activity is not business related, then you are not a trader, you are an investor. So IRS sees you in two different ways. You as an individual, you consider yourself either a day trader, a swing trader, a scalper. Some people consider themselves a long-term investor. Well, IRS sees you either as a trader or as an investor. Regardless if you call yourself a swing trader, a scalper, or day trader, you're either a trader or an investor. So how those two are taxed are very different. So there are three categories of traders. There is the individual self-directed investor. That is the majority of traders in the stock market. The individual self-directed investor is trading under their social security number. The trader that is trading under a business is actually what IRS consider a trader. And then there is the individual that is trading under a business and also elect mark-to-market election. Those are three types of categories of traders. Now, how are those categories are taxed? As an individual self-directed investor, you are taxed on capital gains. Any trades that you keep for over a year is capped at 20%. Now, it doesn't necessarily mean you are going to be taxed at 20%. That's a whole totally different subject when it comes to the tax bracket. But you are capped, meaning the highest that you can be taxed is at 20%. For the short-term trader, which is the day trader, which is the actual trader, right? That trader is taxed on short-term, which is anything under a year, it's capped at 37%. Now, there are ways to get out of those categories, but we can discuss those in another channel. But how you are taxed are on capital gains. And that is very important to learn as a trader, right? Now, as a day trader, IRS gives you the opportunity to either trade under what's called a TTS status. That's another episode. Or you can trade under an LLC. Or you can actually be an investor where you just purchase stocks, you purchase long-term leaps, where we're in 2022, right? So you could be purchasing 2024, 2025, which is coming out soon on leaps. Those are long-term investor. Now, you are taxed less as a long-term investor than you are as a day trader. But as a day trader, you also have the advantage of trading under an entity or qualify for TTS status, so you can take advantage of tax benefit. I say it all the time that tax benefits was created for business owners, not individuals. So as an individual, there's nothing that you really can deduct besides what interest that you pay on your home or property tax, or if you itemizing, because the standard deduction is so high that there's nothing really to itemize. But as a trader that is trading under an entity, you have the ability to deduct all expenses that is related to trading. So this is how a trader is taxed. But the most important thing to know is to identify what type of trader you are. Are you a day trader or are you a long-term investor? So we will go over more. What is TTS? The difference between trading under TTS or LLC, the difference between trading under Social Security number or EIN in another episode. Thank you so much for showing up today. I'll see you guys next time.